Good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Sunday for Sunday, April 2nd, 2023. We hope you're having a great weekend. We've got members of the media, academia, financial services, and government standing by as we analyze all the news and events for the week. So sit back, relax, enjoy this episode of BRN Sunday. Well, we're going to kick things off and look at what's happening on Capitol Hill. Joining us on the line, he's one half of the famed Legal Eagles, Kevin Walsh. He's a principal with Groom Law, an employee benefits law firm based in Washington, D.C. Kevin, thanks so much for joining us again this weekend.
Good morning, Jeff. Good morning, listeners. It's always good to be on your show.
Appreciate it. And Kevin, we often talk about legislation, regulation, litigation, and now arbitration. Something going on, I think, in the retirement industry. We've been talking about ESG with you and David for quite some time, as well as some others. There appears to be some new litigation. I think the president had vetoed, just from background, I know you'll give it, the president had vetoed a potential congressional stop to the DOL rule, but there seems to be some litigation that has creeped up recently.
There is, Jeff. And one of the interesting things is that environmental, social, and governance investing has been a focal point in terms of DOL's regulatory focus for a handful of years, with the Trump administration doing one rule and then the Biden administration doing their own rule shortly after taking office. And ESG, though, has turned into a political football and a very hot topic. Mm-hmm. I think we've talked about it before, and we've said, the guidance is ping pong, depending on who's been in the White House. Well, we've now gone past the ping pong stage, and we've got two sides that are fairly fiercely opposing essentially whatever the other side does on ESG. So it's become a hotly partisan matter. So the Biden administration issued a rule. Republicans largely led an effort to legislate and essentially repeal the rule. Their big holdup in terms of repealing the rule was that you need the president to sign legislation to enact it into law. And unsurprisingly, President Biden, whose administration enacted the regulation, vetoed the attempt to overturn his administration's rulemaking. And that's led to litigation. So, Jeff, you lead off by talking about litigation, legislation, regulation. We're hitting all three of them this morning. And right now we've got essentially a group of 25 states, plus an energy company, and a participant suing the Labor Department in Texas over the ESG rulemaking. Essentially, the argument is that the new rule impermissibly conflicts with ERISA by saying that fiduciaries don't have to act solely with a motive of promoting financial interests of participants by permitting them to consider ESG considerations. That's what the lawsuit alleges. I kind of don't want to get into what the rule says, because one thing that I've said before is that I'm fairly frustrated that it seems as though neither the proponents or opponents of this rulemaking are doing a great job at reading the text of the rule. But so earlier this week, the Labor Department filed their initial response to this rule. And, they said essentially in it that the rule does not require fiduciaries to take ESG factors into account where they prudently decide not to. And it certainly doesn't mandate ESG investing. So they went on to say that essentially what the Biden rule does is it leaves in place the tiebreaker. And that this new rulemaking was necessary because the Trump era rules had a chilling effect on fiduciaries' consideration of ESG factors, even when those factors were material to financial performance. Now, I think we're going to have to watch to see where this goes, but we're heading for an environment where this is going to be a hot topic. If you talk to folks from labor from 2016 to 2020 who were involved in the prior rulemaking, they'll point out that the text of that rule permitted fiduciaries to consider ESG factors when there were ties, and they permitted fiduciaries to consider ESG factors if they were economically material. That being said, the Biden administration may have some points here about, some of the record keeping requirements of the prior rule could have chilled consideration, and the way that the rule was interpreted in the community could have caused some confusion. So I think where this leaves us with, the Biden ESG rule in effect, where, essentially the Biden administration is saying in court and saying publicly that this says you can consider ESG factors to break ties, assuming you've concluded there's a tie on all the economic factors. But it doesn't leave us in a position where, where there's a big rush to ESG in the investment community. And it also leaves us in a position where, I think we're set up for litigation, regulation, and legislation for the foregoing future as the two sides battle over, just when there's a tie. And, if there are circumstances where fiduciaries should be able to consider ESG factors apart from ties.
Kevin, this back and forth kind of reminds me, you remember playing baseball as a kid, and there was a game that you played to decide who got the bat first, where you take the bat and you put one hand, everyone put a hand above the other hand, and the person whose hand was the last one at the top won, I guess, got the decision to either bat first or take the field first. And it sounds this back and forth kind of sounds very similar to that, and that it just ping pongs back and forth. I guess there's a lot of different analogies.
Well, Jeff, I think that's a great analogy. I mean, but I think you're optimistic that there's a top of the bat.
Oh, that's true. I was going to ask you. I'm sorry, not to interrupt you, but I was going to ask you: is this ultimately, because what I've learned from you and David is that, okay, this goes to a court, the court rules, then someone appeals it, then someone may appeal that decision. There may be a decision, and ultimately it winds up at the Supreme Court. Is that where this could all head, because it's in federal court, right?
This is in federal court, and at some point this case will be decided, probably middle to end of the year. Whoever loses could appeal to the circuit courts. The Fifth Circuit governs Texas and a number of other states down there, and ultimately it could be appealed to the Supreme Court. Now, if we get a decision from a Supreme Court, or if this rule is struck down, or even if it's held up, either way, a future administration isn't going to be stopped from engaging in their own rulemaking in a similar area. So the Supreme Court could even decide something like this rule is okay, or this rule is invalid. But even if the Supreme Court weighs in on this, since this is an area where there's a lot of nuance and a lot of opportunity for different interpretations, it's unlikely the Supreme Court will say this is the only way to interpret how a fiduciary can prudently invest. So, even if the Supreme Court weighs in here, it's unlikely that's going to be the top of the bat in terms of your analogy. And there will probably still be room for more hands on top as this rule ping pongs in future administrations.
I mean, it just feels to me, Kevin, again, being a layperson, and I'm going to let you go in a second, but it just feels very similar watching all this kind of stuff unfold to what's happening, different area, but the student loan forgiveness, right? And how that's kind of ping pong back and forth. Labor education department says it can do it. The president can do it. This group says it can't. It seems very familiar. And I wonder if that's going to be the track for the next couple of years until we get to the presidential election, which I think is in, what is that, in 25, 26, right?
2024.
Oh, yeah, that's right. Today is 2023. Okay, I don't even know where I'm going, but you know what I mean? Doesn't it feel like it's just with new regulations, this seems like the path forward? And I'm not trying to give anyone any ammunition, but it just seems like this is, hey, you don't like it and you don't appreciate it. Okay, well, now we're just going to litigate, and we're just going to try to find the right solution legally rather than the right solution based on the text of, for example, ERISA or whatever statute.
I think we're likely to see a fair amount of litigation over over the coming years over DOL action, but I'd be surprised if it stops when there's a change of administration. It's unfortunate that ERISA has become that retirement security is becoming a more partisan area. It's good that in some ways it's managed to stay nonpartisan. We saw Secure 2.0, but some of the regulatory action seems to be increasingly viewed as partisan, and it's unfortunate, but it does mean that courts have to get involved more often.
Yeah. Well, Kevin, this one's going to be interesting. This is one that has reached the mainstream press media, and one I think we're going to keep talking about. Give our best to your colleague, David Levine. Great to talk to you as always. Thanks for your insight, and we look forward to having you back on the program again very soon.
Thanks, Jeff. Thanks, listeners.
Bye-bye.
Bye.
Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions, and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. Now time to break down market events. Joining us on the line, he's the lead anchor for the TD Ameritrade Network, where he anchors 2 shows and contributes to so many others. Oliver Rennick. Oliver, thanks so much for joining us on the program this morning.
Sure thing. Thanks, Jeff.
And you're part of that great team over at the TD Ameritrade Network. Lots of great.
That's right.
You're not the only contributor. There's so many other great contributors there. Training, trading. You talk about it all. Oliver, how was the week that was in markets?
It was very interesting. It was kind of a slow grind, and it was very bullish for the most part. Ultimately, the stock market found quite a bit of conviction in strength from the last 5 months that is now building up into a technical bull market in the NASDAQ. There remains a pretty big difference between the tech-heavy NASDAQ and other parts of the market and other indexes like the small-cap Russell 2000 that potentially could be a little bit of a yellow flag. But at this point, there really is quite a bit of momentum that, regardless of kind of what you think about the fundamental outlook for the economy, if you're a trader and you respect charts, and you try to be objective, it's impossible to deny the resilience that the market has displayed over the last, particularly these last 3 weeks, but really stretching back to the fall last year when we put in a technical low.
Yeah, well, rate increases, tech layoffs, performance hasn't been great. You've been telling us about that for a long time. I want to ask you about commercial real estate. I've been reading a lot about that, hearing a lot about that as being a weakened sector of the economy, just I guess because people aren't going back to the office. I mean, you know the whole story. Any perspective there in terms of some of these real estate companies, these lenders, these banks that have so much at stake with some of these office buildings?
Sure. Well, the real estate conversation is very closely related to the bank conversation, given the overlap in the role that lending plays on opposite sides for each of those two participants. But so that in that sense, commercial real estate, I think, has become particularly in focus. However, that being said, to me, it seems like one of these areas that really should have been on everyone's radar for like 2.5, 3 years now, because of the probably most consequential permanent lifestyle shift after COVID, which is remote work. It doesn't take a market analyst or a Wall Street genius to drive through basically any major city other than Miami or Austin that has seen this influx of people to see that most major American cities and commercial real estate is like depleted compared to where it was pre-COVID. I mean, even in a place like Chicago, it's just very obvious how many vacancies there are. So it's only a matter of time before this ultimately causes some financial stress for these companies. Not really clear what's going to replace the offices, what type of businesses or establishments are going to, replace these empty offices, but it's pretty clear that they're not going back the way they were. So on the one hand, yes, I would imagine there's probably some substantial market fallout that still probably hasn't been realized. But at the same time, it should be like the most obvious thing in the world at this point. So I don't think it should be too surprising. Like I don't see like an imminent, like major collapse or crash. It just feels like that should have been priced in over the last couple of years. Probably will not be a great place to invest as like a commercial REIT or something for office spaces. But we'll see what they turn into. I mean, some are going to turn into multifamily, like housing and condos, and some of the street level stuff might turn into other establishments, but we have to wait and see. It probably is not a great outlook for commercial real estate, but like this idea that it's sort of like this a big, apocalyptic nuclear bomb in the market is just hard for me to it's hard for me to describe it that way when it's so painfully obvious that it should have been that way for like 3 years now.
Well, come on, Oliver. We're all going to be working in the metaverse. You, me, we're all going to be avatars, and we're all going to be replaced by Chat GPT, which apparently can write Amazon reviews. It can write term papers. Who needs humans?
Right.
Oliver,
go ahead.
Yeah,
it's a little bit. It's moving pretty quick.
Yeah, no. Next thing you know, we got Cyberdyne. Real quick, that's for all the Terminator fans out there. Last question, Oliver. We always talk about equities with you. Let's talk a little bit about the bond market. How's the bond market doing? Treasury yields. Usually Treasury yields are a recession indicator. What are the tea leaves telling us so far?
Right now, that is probably one of the main reasons, if not the main reason, why stocks have been so strong. As yields dropped around the bank crisis, probably for not good reason, right? Like it's probably not good that yields are down right now because of the event that caused them to go down. But investors are really, really adamant about this notion that interest rate hikes from the Fed are basically like all that matters for the stock market. And so we see that as soon as yields come down, the market starts pricing in rate cuts for the Fed, and that is, I think, indisputably a very, very big part of why stocks have rallied so much. And that's kind of where the concern is, because even though inflation on Friday was in line with expectations, it's still 5%. That's the Fed's preferred gauge at 5%. So it's more than double what they say they want, which means that the idea of cutting rates just is not realistic unless there's a huge financial fallout or, big macro event. But as we see from the past 2 weeks, if you just look at the stock market, it says the bank thing is basically, we've moved past it. We've moved on. So it's a very, very kind of oxymoronic situation in a way, where like investors are saying we're going to buy a bunch of stocks because the Fed's going to have to cut rates because of the bank situation, but then also like bank situation is not that big of a deal. It's a little bit odd.
It is a little bit odd, but that's why we have you to help break it down. Oliver Rennick, who buttresses the coverage on the TD Ameritrade Network. Thank you so much for joining us, and we look forward to having you back on the program again very soon. Enjoy the rest of your weekend, my friend.
All right, thanks, Jeff.
Bye-bye. And that wraps up this episode of BRN Sunday. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the latest curated news and lifestyle, wellness, finance, tech, so much more in all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives, check out our latest content? Well, visit our website and, of course, all of our streaming partners. We're back again tomorrow for another edition of BRN AM. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.